Good morning, everyone. Today, we're going to talk about DTI structuring. If the credit was about the score, today we're going to talk about the DTI ratio. DTI is where the file lives or die. So you can have a great credit score with a strong income, but still get a decline because of a ratio is a single dollar over a cap. The good news is, just like the credit, DTI is something you structure. So by the end of this training, you'll be able to do 4 things. Calculate a numerator to the dollar, find that you can legitimately omit, deploy compensating factors when the ratio is tight, and pivot to DSCR when the personal DTI doesn't even apply. Let's go. So let's see the stakes. Income gets you in the room, and DTI decides whether you sit down, and a few million dollars can flip a decline to an approval. With the compensating factors, DU and LP can push DTI past 50%. Surprisingly, the cap is not the hard line. $1 over can be an entire difference between yes and no. So there's a DSCR, the investor pathway, where personal DTI doesn't apply at all. Keep that exception in the back pocket, and we'll close the session on it. So let's define these 2 ratios, the front end and the back end, both measured against the same gross monthly income. So picture 2 buckets under one faucet. The front end, the housing ratio, is just a proposal housing payment. The PITIA divided by the gross income, gross monthly income, is tracked mainly on FHA and manual files. The back end, or total debt to income ratio, is housing plus all your other monthly debt divided by income. That's PITIA plus debt over income. So this is number that governs almost every approval. So when I say DTI without qualifying it, I mean the back end. So DTI, the reference table, we need to teach ourselves these are starting points. The AUS adjusts, not as ceilings. Conventional through DU and LP typically runs, about 50% and can stretch to 50 plus with reserves and equity. FHA shows 46 to 56 through AUS, manual caps closer to 31 to 43 with compensating factors. Non-QM is a program-specific, often 50 plus, driven by reserves and LTV. So 2 outliers to burn in. VA has no maximum DTI. Residual income is the real test. So the DSCR shows not applicable, but because personal DTI isn't used at all, the proper cash flow qualifies the loan. So on conventional DU and LP for the refinance, refi now, refi possible goes up to 55. And the VA, when the debt to income is exceeding 65%, there's an extra add-on pucks in. So this is the numerator, the top of the fraction. So when you talk about the rule, it shows on credit or recurs monthly, resumes it counts until you prove otherwise. So what lands here is the proposed PITIA, the minimum payment on revolving cards and lines, installment debt with more than 10 less, and court order items like alimony, child support, PITIA on any other property not offset by rent, and co-signed or contingent debt. So default to it counts, making something you document, something you sometimes, something you hope for. The sneaky one is a co-signed debt, right? It counts unless you can prove someone else has paid for 12 months. So if it's a mortgage account, we provide a copy of a note, and the lien holder on the copy of a note must differentiate yes or no. And the monthly lease on the vehicle paid by the third party for the last 12 months will be the determining factor. So the fine print is where we can get the wins most of the times. Mostly commonly excluded items are utility, phone, insurance, medical bills. Those aren't debts. Installments with 10 or fewer payments left on the most products. Debts paid by a business with 12 months of cancel checks. Debts paid by others with 12-month proof. And the 401k loans because you are repaying yourself, but always include these items. The minimum revolving payments, even with the client pays the card in full, deferred or income-driven student loans per the product formula, lease payments, these are never omittable by remaining terms, whether you have 1 month or 5 months, you still consider them. Because leases renew, co-sign debt without the 12-month proof, and the alimony, child support, garnishment. Those two traps, leases and the revolving minimums, are surprising the newer loan officer especially the most. So let's dive in the PITIA and build it the correct way, because errors here quietly inflate the numerator. So P and I are the principal and the interest at the locked rate and term. T is a property tax annual divided by 12, and I is a homeowner's insurance premium monthly, and A, the association is due, and HOA or the condo fee. MI is the mortgage insurance, PMI or MIP or VA funding consideration. So differentiate the private mortgage insurance versus monthly insurance from conventional to FHA. The classic miss is the taxes. So on the purchase transaction, home is often reassessed at the sales price, which can be far higher than the seller's current tax bill, right? Estimate forward, not off the old bill. And watch for the HO6 on condos, flood insurance if it's a zone, and special assessments. So how do you calculate and consider revolving debts? It depends on what the report says. If the minimum is shown, use it. But if no minimum is shown, use a 5% of the balance on conventional and FHA, unless you document a lower payment. On a HELOC, use the actual required payment or the interest-only amount if it's IO. A pay-in-full charge credit card, like American Express, may be excluded with a proof of funds. If the $10,000 remaining balance is showing on the American Express and providing a $10,000 checking statement, bank account will be excluded from the calculation. And the 30-day accounts can be excluded if documented asset over the balance. So here's the lever. A card with no minimum reported is considered and counted at 5% of the balance. A $4,000 balance becomes a $200 phantom payment. So paying it down, paying off on the documented funds can raise that easily. Always verify each investor's trade lines and accounts. So one of the cleanest DTI lives here, this rule, the 10-month rule. Installment debt with 10 or fewer payments remaining may be omitted on the most products. So FHA adds a condition, 10 months or fewer, and the payment is small share of income. So logic here is that when a nearly paid off loan won't maturely and materialistically affect the borrower's ability to repay. But leases never qualify, assume renewal. So when a car payment is, let's say, 11 months, we can lead the clients to bring down to 10 months or below so that we can omit that complete payment. So here's a play. Set an auto loan that has a 13 payments left on the $480 monthly payment. Prepay 3 months, now it's a 10 or fewer, so you can omit the full $480 from the DTI. The single move here can clear a 2 or 3% overage. So always check the remaining count and confirm the product allows omission. So going back, don't full pay it off. Do not consider that kind of a situation when an installment payment comes in. So let's collect the omission toolkit here. The common idea we share is 12 months of proof that someone, like a third party, other than the borrower, truly carries the debt. The business paid debt. So when you talk about the C Corp, S Corp, LLC debt, the account is in the borrower's name, but the business pays for it. Omit with 12 months of cancel check or business bank statement. This one is huge for our self-employed clients. Paid by others, the non-co-borrowers have paid 12 months on time with their own funds, omit their proof. So this is a key. 12 months on time, consecutive payment is a key. When we have 11 months of payment by the third party and accidentally made the payment with our account, our borrower's account, for 1 month in the middle of the 12 months term, that we cannot omit that payment. So make sure you collect all these 12 months payment histories. And the 10 payment installment we just covered and prepaid to get there, bring down the payment due. So, and the contingent liability, the co-signed loan, other party actually pays, omit with 12 months of payment proof from the party. Paper all these, properties, documentations, and exactly target the area that we need to overcome. So mortgage, as I mentioned before, collect the copy of a note and make sure the third party is listed on the copy of a note. Don't apply any exception on this. I'm going to briefly cover the student loan once again. So student loan byproduct are the most miscalculating debt in the files, and the payment use differs sharply by the programs. So when I see people submitting FHA loan and conventional loan, you guys are not calculating correctly. So I'm going to set a specific milestone, specific guideline here. So conventional uses actual payment on credit, including a documented zero, income-driven repayment payment. Otherwise, 1% balance or fully amortizing figure applies. FHA uses the actual payment, but it's zeroed or deferred, then impute 0.5% of the outstanding balance. VA uses actual payment, but with the deferred over 12 months of sometimes gets excluded. So run the DU and find out whether the student loan is deferred and excluded completely with VA. Non-QM is program specific. So here's a note that I made. Documented income-driven repayment, even with a zero, with a 1% calculation. $90,000 loan with a 1% $900 a month, but documented with 1/5 of IDR payment. Usually we can use that. So we can either drive this into $0 per month. So always pull the servicer statement and then confirm the guidelines, because these can change in the middle of nowhere. So on the manual and FHA files, when the credit score is below the norm, let's say 620 or 600, then we have to consider this manual underwriting. And two conceptual ideas matter: payment shock and the housing ratio. Payment shock is the new housing payment divided by the current housing payment. So 24,000 new over 1,200 now is a 2 times or 100% increase, right? So the high shock on a manual or first-time home buyer file invites disparity and difficulties. You offset it with reserves. So that's why when you complete the 1003, we encourage loan officers to collect the current lease statements. So for the QM and non-QM, we don't know which direction we're going to take. So make sure you collect the current housing payment and the proof as well. So why do you care? The manual FHA weighs the front-end housing ratio very hard. So low payment shock is the documented compensating factor. So when a renter who's already paying more than the new PITI in a strong file, you show it up front and get an exception over it. First-time home buyers with no rent history draws the most caution, so flag the shock proactively. That's why no housing payment, LOE can play actively time to time. So qualifying income is the fraction that we need to talk about. So everything so far was a top. The bottom where we need to focus right now is the qualifying income. So when we talk about the W-2 borrowers, the base income plus documented variable income, such as overtime, bonus, commission at a 2-year average. So when you have lesser than 2 year, don't even consider them. Have a hard stop on it. Self-employed borrowers use net income from returns or bank statement deposits on non-QM. So rental income, 75% of a gross rental for vacancy, or DSCR on the 100% for investor loans. So what are the other ones? Social Security, pension, asset depletion, child support, all grossed up if it's non-taxable. The point that I want to make is that you can fix a ratio in 2 ways. Shrink the numerator, which you've been doing, or grow the denominator, gross up the non-taxable income, and add documented variable income on it. Don't forget the bottom of the fraction. So when the DTI ratio is high, these are the arguments for a yes to AUS approval or to deal with non-QM manual underwriters. Reserves are the single strongest factor, the ones of PITIA in the bank after closing. So low LTV or strong equity reduces risk and opens up the DTI. So low payment shock, documented, reserve income, and residual income, such as cash after all payoff and obligation, can become a the determining factor. The credit well above the minimum also is, outweigh rules. A stable, long tenure employment also works. Anyone who was employed more than 5, 7, 10 years from the same employer also considers betterment for us. So when you coach the loan officers to document compensating factors proactively in the file. So don't wait for the conditions to come out. When you're interviewing the borrower and hear all these compensating factors, add them in the submission form and the notes. It changes the underwriter's starting posture. So you're handling the file with reasons to approve before they ask. So let's talk about the VA. So we have another file we couldn't fund. It was a USDA file, but the VA also runs the same guidelines. So I'm going to cover this. So VA, surprisingly, is a widely misunderstood product. Because it has no maximum DTI, it's asking for a better question. So do we have enough money left to actually live, right? So the test that I want to apply is gross income minus tax, minus all debt, minus PITIA, minus estimated maintenance and the utility equals a residual income. This residual must meet or exceed the regional table here that you see on family size and the region. So numbers on screen is illustrative, but it can change depending on which country we're applying the loan to. So the power on it is a veteran with a 55% DTI can sail right through if the residual income is very strong. So teach the residual formula, and it's you can Google search and find out immediately. So when you originate VA loans, you have to pull this current regional table and then apply at the same time before you lock in the rate, before you submit the file. You'll be saving a lot of time by doing this. So example number 1, let's go over very slowly. Conventional file with a gross monthly income of $8,000, proposed PITIA is $2,300, and auto loan of $450, credit card minimum of $180, and a documented IDR. Student loan at $120. And second loan was 9 payment left, so we omitted that. So when you counted that, the $2,300 plus $450 plus $180 plus $120 over the back end. So when we use the $8,000 as a the denominator, we have a DTI of 38.1%. So this is a clean approve eligible file. Notice 2 structure moves back then. 1, we use the documented IDR instead of 1% default. And second, we omitted the auto loan because it's following under 10 months rule. Without those, file was very difficult. Let's look into second one. The FHA, gross monthly income of $6,500, PITI with MIP, with a loan amount was $2,050, auto loan at $390, credit card payment at $140, and for FHA, the $40,000 rules apply because we use 0.5% of the student loan, which is at $200. If you calculate these two, the DTI was at 42%. So front end under 46.9, we were able to get a approval. So when you see anything under 46, this is the AUS range. So the loan officers usually assume deferred means 0. On the FHA, it doesn't. You calculate the 0.5% of the balance and you can omit it. Knowing that upfront prevents a redisclosure and awkward calls to the borrower. So on the DSCR, don't mix with DCR and DSCR. DCR is for the commercial and the 5 to 10 unit properties. DSCR is the 1 to 4 unit investment-friendly loan, investor-friendly loan. So on this type of loans, throw out everything we just talked about, DTI and personal debt to income. The property qualifies itself. No personal DTI, no pay stubs, no W-2, no tax return to qualify the loan. 1003 employment is completely blank. We recently had a file. DSCR loan was submitted with job information in the 1003. So the lender and the disclosure was asking for additional information. Don't make the same mistake. No personal DTI means entire test is based on property's cash flow, rent versus PITIA. It's a business purpose, non-owner occupied product for investors on a 1-to-4 unit, right? So for the DSCR files, the borrower's personal debt and the income simply don't matter much on the qualification. Different product applies different qualifier. The whole point, changing the pivot, determines yes to a no and no to yes. So this is how DSCR is calculated. DSCR equals monthly rent divided by PITIA. And remember, PITIA here is the same component as before, tax, insurance, HOA, all included. So here, these are the things that you see price differences on the loan sifter. 1.25 or above means rent comfortably covers the payment. Best pricing and leverage. This is the best case. When you see anything like this, then consider these buyers as rate shoppers. Offer them the best rate and term fee and lock it in. 1.0 to 1.24 is usually the standard. Rent covers the payment, but this is where the bread and butter comes in. 0.75 to 0.99 is a slightly, ever so slightly shortfall, allowing many lenders and price up, right? So this is where the shortfall, this is where we win the most. Look into this, no ratio where the cash flow isn't used at all carries the highest rate and lowest LTV. So you may say, Peter, a $26,000 monthly rent over $12,000 PITIA, it's 1.3 DSCR. However, when it's flip-sided, $2,000 monthly rent with a 2,600 PITIA, it's a no-go. It's not. If you apply hard money rule over this no ratio DSCR, you can beat and win every single transaction because hard money loans usually start at 9.5 to 10 point, right? Anything that beats this kind of rate, no ratio DSCR with 1 year prepayment penalty usually starts with 7s. And when you want the rebate, 8s and 9s will make you the most. I'm going to go over the action items later on regarding this no ratio DSCR product. So let's go back a little bit furthermore. Let's put all things into together. One is a DTI. This one-page DTI map can help you. Identify the borrower type first, and it dictates the entire approach. W-2 or salaried. Standard DTI, right? Trim the numerator, add variable income. But self-employed, use net income or bank statement. Business-related deposits for the non-QM transactions. The high DTI, but otherwise strong file, stick the compensating factors such as high reserve, low LTV, or higher FICO scores. But on a VA, go to residual income, investor or rental, and pivot straight to the DSCR and ignore personal DTI entirely. The borrower type is the folk in the end, right? Get that right, and the qualification approaches itself. So this is what I see the most. When I was reviewing you guys' submission files, this is rapid fire that was killing the file, but we were able to change the loan product from 30-year fixed to ARM to 30 years to 26 years fixed using UWM's flex term. So look into this closely. A card with no minimum reported is considered a 5% of balance, paid down or paid off the source funds. A auto loan, auto finance product, just over 10 payment hits a DTI in full. So prepaid to 10 or fewer and omitted. A deferred student loan carries a large imputed payment. Document the actual IDR on conventional. Remember, FHA uses 0.5%. Business debt sitting on a personal credit drags a personal DTI. When you see multiple auto loans, ask them if the third party is paying for it. Provide 12 months of business paid proof and omit it. Print this and just memorize all these factors can apply on every single loan transactions. So when you understand the module and memorize, then you'll be able to understand how to determine which product to sell and which lender investor to send the file to. Backend DTI governs all. Build a numerator to the dollar. Omit smartly. 10-month payment rule, business paid by others, and always 12-month proofs. Student loan and no minimum cards are the silent killers, right? So make sure you review 1003, run the DU, so find out the glitches, problems up front before you submit the files, right? Don't wait for another week. Run the DU on your end and then find out the results. So The LTV and the DTI sessions we went through for the last 2 weeks, the credit decides the score path. DTI determines the ratio, and together you can decide which file are surviving and not. Document every move, make a note on the ERP so that whenever you make a misjudged, I guess a pricing or loan product, one of us can step in and help. Without all the documented information, we cannot give you the best case solution. Any questions on today's training tip? If not, I'm going to go over some of the highlight that I want to cover today. So this is a partner program with Metro City Bank. We announced it last week. Now files are coming in, so I wanted to highlight and emphasize some of the things. First trusteed, loan amount maximum at 2.5, LTV caps at 70% or below. FICO score 700 is recommended, but when you have a no FICO score, LTV is at 55. So imagine all these 400, 500 hours, don't kill the file. Send it to Metro City Bank, fund it using the cash proceeds to pay off the credit debts so that, as soon as they become 700, we can refinance immediately using our 30-year fixed product. Clean the debt with the Metro City Bank product and increase the credit score and refi with our product. Remember, Metro City Bank product has no EPO. You can fund and close their product and then refi with ours the following week. You don't have to shy with XYZs. So scenario test comes into play because most lenders we work with have EPO rules. When you hear this borrower is about to sell the house, a real estate companies asking for bridge loan because they are trying to list the property. Don't kill the file because of a 6-month rule. Apply using this product. It is available. Bridge loans, LTV at 70 still operates here. This is a very easy product. When you change your eyes and ears to the audiences, then you can create transactions a lot easier, faster than you ever think. All these pre-foreclosure deals, they all work. Contact your title officers and ask for title deeds, right? Many different options can apply.